There are three different ways of interpreting price action when analysing charts. These are line charts, bar charts, and candlestick charts. A simple line chart draws a line from one closing price to the next closing price. When joined together, we can see the general price movement of a currency pair over a period of time. A bar chart is a little more detailed. It shows the opening and closing prices as well as the highs and the lows. The bottom of the vertical bar indicates the lowest traded price for that time period, while the top of the bar indicates the highest paid price. The vertical bar itself indicates the currency pair's trading range as a whole. The horizontal line on the left side of the bar is the opening price, and on the right side horizontal line is the closing price. Candlesticks are easy to interpret and are a good place for beginners to start with when interpreting forex charts. They are the visual representation of the market movement. Each candle is worth 1 unit of the time period you are using. For example, if we were using a 5-minute chart, each candle is worth 5 minutes of movement. Candlestick charts show the same price information as a bar chart, but is a generally preferred format to analyse price action. Candlestick bars still indicate the high to low range with a vertical line. However, in candlestick charting, the larger body in the middle indicates the range between the opening and closing prices.